I'm Roger Royse. I'm the founder of the Royse Law Firm. We're about 30 lawyers based in Menlo Park. We work with almost exclusively technology startups. Do some work for the funds, for a handful of venture funds. You got to keep your enemies close. So we know both sides of the equation, but primarily it's for startup companies, and we're full service. We do everything for them. Been doing it for about 35 years. Been here in Silicon Valley since '91. Been at the Royse Law Firm since 2006. And over all those years, I guess I've gleaned a few things about startups and startup cultures. I've seen, a lot of companies crash and burn. I've seen other companies be really successful. I'm still not a perfect stock picker. Otherwise, I'd be a client, not a lawyer. But I still, still think I've seen some patterns for success. And there is a right way of doing things. There is a Silicon Valley formula. And I've been doing it so long, it's sort of second nature to me. But I find that people coming to startups, especially from other areas, might not be so obvious. So we're going to walk through that here. And some of these things might not be obvious to even the veterans, and maybe even disagree with me. How many startup entrepreneurs in the audience, by the way? Almost everybody. Any investors? Angel investors or VCs? Okay, one or two. Yeah, disclaimer. Legal language. All right. So I want to divide this into three pieces. Kind of like this picture. I like to think of companies having three real components. One is the people, the other is the technology, and the third is the money. And that's, I like to think in terms of three. And that's how we'll take this. Now, I've given this presentation before. Some of you I've seen before, so I know that you've heard it. And the trouble is, I've got about 1 million slides here. I never get all the way through it. I'm going to mix it up a little bit this time, go a little faster, because I want to get to some of the financing options at the end that we don't seem to have time to talk about. So, so let's talk about splitting founders' equity. And this is the very first decision. By the way, those of you who are entrepreneurs, how many of you have a co-founder? Yeah, almost all of you. And so it's been my experience that the more successful companies will have a technical co-founder or a technical founder. And it's pretty rare that you find a startup where you find one, not impossible, but let's say it's the minority of cases where one person has the technical knowledge, has the business knowledge, has the connections to the venture world, all of those things you need. So usually you see a team. And I think it's a lot easier to be successful if you have a technical co-founder rather than trying to go out and hire that technical person. You can do it, but I don't think the investors like that as much. So because you probably have co-founders, the first decision you're going to have to make is how you're going to split up the equity among your co-founders. And the default, of course, is to just split it equally. That's what everybody does, it's what everybody wants to do. It's the easiest way, it's the simplest way. It's the most common way, but it's probably the worst way. And I've got a couple examples of that. Zipcar is a really good example. And this is all public. I know we're being recorded, so I don't know this through personal knowledge. I only know what I read on the internet, so it must be true. But this was a case where, very typical case, where you had more than one founder. They split things up equally, and almost immediately afterwards, one of the founders, was just missing in action. Now, this company is notable because it was successful, notwithstanding that you had two equal partners who were not created equally, and one was doing all the work. And the partner who did all the work, was pretty vocal about being a little bitter about this. Now, what usually will happen in that scenario is that company will crash and die, because a startup, it's a pretty fragile thing early on. It's very fragile. It doesn't take much. I mean, really, the strategy's got to be perfect, but the execution has to be perfect as well. And if something is wrong, like the equity split, that's going to be a really bad fact. Yeah, like she said, a huge amount of angst over the next year and a half. This story turned out well, but oftentimes it doesn't. So how do we make sure that story is going to turn out well? How do we make sure we're going to split up that equity in a way that everybody views as fair and doesn't cause a tremendous amount of angst, doesn't cause people to leave, doesn't cause fights, that sort of thing. So the 4 ways that I see founders split up equity are on the board here. And like I say, the first one, equal percentages. That's what's commonly done. It's better than nothing. And by the way, I have seen nothing. I have seen people, just not talk about it because it's so uncomfortable, until it was too late to talk about it anymore. But another way that we see above that is a negotiated split or a subjective formula. Before we get to dynamic split, let me talk a little bit about negotiated split. That's probably better than equal split because at least people think they're getting a better deal, but really what you're doing is you're rewarding the person who's the better negotiator, or usually the person that can pound their shoe on the table the loudest. So I'm not sure a subjective split is that much better. A formula, that at least has this objectivity behind it. Look, I'm full-time, you're half-time, so I'll be 2/3, you be 1/3. That makes a lot of sense, okay? And that's the simplest formula, but you would find a formula like that. But once you start going down that path, you're going to come into some of the more sophisticated formula. Now, one of the things that we do from time to time is what we call the dynamic split. And this the difference is with a formula, you kind of take a picture right at the front end and you say, look, you're going to bring this to the startup. I'm going to bring that. Third partner is going to bring, that. So we'll divide that up and we'll evaluate it, or value it based on these objective criteria. And we take a picture and that's who you are going forward. The dynamic split, on the other hand, is a moving target. Dynamic split means that we are constantly valuing every founder's input into the company. And at any given time, we'll take a picture and we'll measure the value of every founder's inputs as a ratio of all founders' inputs, if that makes any sense. That's called dynamic split. Now, there are several calculators here that do this. The one that's most often used and the one that we use most often is called the Grunt Fund. It's also called Slicing Pie. You can find it at slicingpie.com. And you can download a set of spreadsheets and it just gives you a formula. It values cash 4 times as much as services, for example. So for example, if your opportunity cost is $25 an hour and you put an hour into the startup, the person who put $25 in cash in is going to get 4 times as much credit in terms of equity than you will. So it weights it weights different factors. And it does this on a day-by-day basis, which means that all the founders, you have to be a little bit like lawyers. You got to keep timesheets. You got to measure what you do every day. And you do that until you come to an event, like a financing, a big customer, revenue, maybe a sale, something like that. And once you hit that event, you just add up all those inputs and you value everything and poof, it's just math at that point as to what the percentages are. We use that from time to time. Actually, I talk more about it than I actually do it once people realize how much discipline it takes. But it does have this objectivity to it. Here's another one. The Founders Pie Calculator is created by this professor at Carnegie Mellon. And this one is a lot simpler, has far fewer factors, but it's the same idea. You put things into a category, you give each category a value, and then you multiply it to come up with a weighted score. So if you go online, okay, I guess we've got an example of a Founders Pie calculator. Founder 1, Founder 2, now they of course have to agree on all of these numbers, but it's kind of basic negotiation. If you can get people to agree to a methodology, it's a lot easier to get to a result. And here's one where they agreed that the idea was worth 70 points. The business plan is worth 10. Or I should say the founder's contribution to the idea was worth 70 as opposed to Founder 2. And you add up all these points and you come up with your percentages. So this is another calculator, a way that people can come up with what looks like an objective calculation. It's not a dynamic split. You just take a picture and you're done. But it is something better probably than equal. Here's the spreadsheet that I was telling you about, the slicing pie method. So you can see it's fairly complex. In each of these people identified as grunts, those are all founders. And you can see time, cash, equipment, just enter them all in. And here's where the actual inputs get entered into the spreadsheet. Then they get rolled up into a summary sheet, and you come up with percentages at the end of the day. So for people that have the discipline, this is a way that is very objective. Now I want to warn you, because if you've ever talked to a lawyer about this, the first thing they tell you is that, well, that doesn't work because it's all going to be taxable. I'm a tax lawyer. I know, I didn't miss it. That's very true. The reason that people think this works, notwithstanding the tax issue, is number one, early stage startup companies are not worth a whole lot, right? There's not much value there. So I think part of it is that these numbers are just so small that people don't worry too much about. So the general tax rule is that if you're paid in property, you're taxable on the value of the property. So if I work for a company and the company gives me stock instead of cash, I still have to pay tax on the value of that stock. It's as if they'd given me cash and I turned around and bought stock. That's the tax rule. It's a little counterintuitive for some people. I mean, why would I have tax when I don't have cash? Happens every day. So the problem behind dynamic split is that people are, not only are you earning stock every day, you're creating a great record for the Internal Revenue Service because you're valuing it on a scorecard that you fill out every day. So like I say, one way people deal with it is just by assuming that the value of the company is not worth the amount of the inputs that they're putting in. And that assumption is not that far off reality, right? Like I said, that startup is very fragile. That's not good enough for me. The way we typically do it is we have a fairly complex vesting concept. Everyone know what vesting is? Vesting is the idea you earn into your shares through continued service. So rather than earning into your shares, the way I would set this up is I would grant all the shares up front and make them unvested, meaning you could lose them, they could be forfeited, and then make a special tax election so you're treated as a tax owner. And then you're not going to be given any more shares for services, you're simply going to lose shares as you go along based on the formula. That's untested, there's no rulings, it's something that came purely out of my mind, but I think it works, and that's how I'll do it if someone really wants to do the slicing pie. Okay, moving along. I want to talk about some other issues that come. We're going to talk more about vesting in a minute. But before we do, the other question I get a lot, and what you've heard about, because of course, a lot of you are going to go Google, you're going to online, you're going to go Google, you're going to find the answers, and you should do that. You absolutely should do that. You should do as much education, self-education as you can. I have a whole book out that you see sitting out on the counter there called Dead on Arrival. It's about companies that have failed. And one of the themes you'll find throughout that book is that these are companies that had lawyers, but their lawyers didn't tell them things, and they didn't ask, and they weren't told the right answers. So you can't assume people are going to tell you what you need to know. You really have to go out and kind of find out a lot of this stuff, or at least know what questions to ask. And if you've been doing that, you probably won't be too long that you would have come across Class F stock or Series FF stock. So let me tell you what those two things are. Because every once in a while, now normally I try to talk people out of doing this stuff. The reason why is because the VCs will hate it. They'll make you get rid of it. But once in a while, we'll go ahead and do it. And if you're the next, like Zuckerberg has Class F stock in Facebook. If you're the next Zuckerberg, you can get away with this. So Class F stock is the idea that, well, look, I'm a founder, but gee, Royse, you convinced me I need a big team. And I don't have a lot of cash, but I do have a lot of stock. So I'm going to reward my team with common stock. And I got all these people around me, including other co-founders. But you know what? This is my company, and I want to control it. And I want to make sure I have a controlling vote for a long time. So my shares should have a higher vote than the others. I don't want to lose control. So it's just super voting stock that gives the founder a right to super vote, additional voting rights. Nothing wrong with that. Just be prepared. It's a complication. You will probably not have that for very long. The VCs have their own idea as to how a company should be controlled, and maybe even your angel investors. But I have used this very successfully with companies that had, kind of a large number of founders, but we really needed someone to be the leader. and to make sure they had that, they had that control if they needed it. So we have used this successfully with large founder groups. The second thing we don't use anymore, but you're going to find it out there in the internet ether. It's called Series FF stock. And here's the concept. And by the way, this was thought up by some very smart engineers, except they were engineers, they were not lawyers. So they had to learn the hard way why it didn't work. But Series FF stock is the idea that, okay, I'm a founder. I put all my sweat equity into this company, my nights, my weekends, et cetera. I've heard that story 100 times, 1,000 times. Now the investor comes along and it's like, I should be able to take some money off the table, right? I should be able to sell some of my stock to that investor. Well, if I sell common stock to if the company redeems common stock from me, I'm going to have a bad tax consequence. And I'll spare you the details, but you just will. On the other hand, if I have preferred stock, I got a capital gains tax consequence, which is really good. So I think what I'll do is I'll issue myself some Series FF stock, and what that means is whenever we do a financing, that FF stock will convert into preferred, and I can kind of ride it out with the investor and get all the preferences the investor gets, or I can sell that preferred stock to the investor because that's what they want. I will tell you right now, on film, it doesn't work as a tax matter. Okay, there's no rulings on this, but it's a very risky, let me put it this, I shouldn't say it doesn't work, very risky thing to do as a tax matter. We think there's a very high risk that the IRS would come along and view this whole thing as a compensatory device and tax the founder at a very high rate of tax. There's an easier way to get there. Okay, if that's your scenario, I've got ways of getting there, but they rely on planning into this on the back end. We'll get to that towards the end. Now, I said I was going to talk about vesting. So when I started doing this, even here in Silicon Valley many years ago, it was hard to bring up this topic. What I asked a minute ago, who knows what vesting is, and everybody here knows. But it was hard to bring up this topic. People kind of viewed me as the enemy if I mentioned it. It was sort of like, vesting, why do you want to steal my shares from me? And that's not how you should look at it. Vesting is a way that the company protects itself, right? And this is a concept, again, and this is one you probably won't get from the internet. This is one you only get from having seen it. That common stock is there for a reason. Common stock is the currency of management and service providers. You need that common, and it's not unlimited. It is the residuary, after the preferences get paid, but it's not unlimited. Company has only got so much of itself in common stock that it can issue. So it needs to be a little bit stingy with it, just a little bit. And what that means is that suppose you have a company with 3 founders and one founder has a third of the stock and they leave, you need that founder's stock back. The company needs that back. That company is not going to be able to attract investors if it doesn't get it back because it needs to find someone to replace the person who left. And I've seen it happen over and over where the founder who left was fully vested and the company was unfinanceable. It just did not have enough common stock pool in order to build the management team that it needed to. And the investors wouldn't invest in it. So how do you get that stock back? Well, you get it back through a vesting restriction. So vesting, again, is a concept that you earn into the stock. And when somebody leaves the company, they have to sell their stock back at cost, which is usually close to zero to the company, their unvested shares back, and they get to keep their vested shares. That's the concept. So it's fair, right? It's fair because you're keeping some of the shares that you earned, and it's fair that you're giving back the shares that you had not yet vested in so the company can replace you. Now, this comes up a lot. Well, question number 1, how long should people vest? What do you think? How long should a founder vest, do you think? What do you think? Okay, we got 5, I got 4. Do I hear 3? I got 3, okay. The answer is 3 to 5. That's what we see for founders, it's 3 to 5. Normally, the companies I set up, I start out with 3, knowing that the investors are going to make you reset the clock anyway, so it kind of doesn't matter. But I start with 3 because that's on the aggressive side, it's founder friendly, but it's good enough to protect each founder from each other founder. 5 I would normally reserve for more optionees, non-founder type service providers. Never lower than 3. Having said never, I just saw 2 years this week, but I think that's a bad idea. But again, it doesn't matter a lot as long as there is a vesting restriction, because if you can make it to the investment round, the investors are going to make you reset it, because they need you to stick around long enough to monetize our investment. Now, acceleration, that's the idea that the founder should get additional vesting if certain things happen. So for example, founded the company, I got this 3-year vesting, and then a year later, we do a stock-for-stock acquisition. Microsoft does a stock-for-stock deal with this. I don't think I should have to vest in that Microsoft stock that I got in exchange for my founder's stock. I mean, I did my job. I got this company liquidity. I think I should be fully vested. That's what we call acceleration on change of control. Termination without cause. That's the idea that, look, there's 3 founders. We all know what happens. I've watched enough reality TV shows to know whenever you get 3 roommates, 2 of them are going to gang up on one, right? And they're going to kick one founder out even though he did nothing wrong. Well, if that happens, it seems only fair that I should fully vest. Okay, we don't give up either of those anymore. You know, in the early days, you could sneak that past an investor. You really can't anymore. People are too smart. The market is too efficient. Where we will compromise, though, and this is the compromise for founder-level people, not everybody, is what we call a double trigger. So what I just described to you are single triggers. Double trigger means both those things have to happen, and then someone will get additional vesting. So in other words, the company got acquired, and it was terminated without cause because they didn't need me anymore. They didn't need a CFO person anymore. Well, in that case, okay, we'll give you some additional vesting. But that's usually the compromise. That's what we see, rarely single triggers. So that's founders. That's part of your team. The other part of your team that you should pay attention to are advisors. Now, one of the things that I've noticed about successful startup companies, everybody talks about the team. They say the team is so important. You know, you hear VCs talk about that all the time on panels. You know, we invest in people. You know, we're all about team. Well, what do they mean by that? You know, if you think about it, is it just like a really smart person? Do they want people with, you know, fancy law degrees? I mean, what do they mean team? Do they want someone with track record? I think those are probably all helpful, but I really think that they're looking for industry expertise, you know, or domain expertise in particular. And sometimes you can't get all that on your team, and you have to go outside your founding team to acquire that. And it might be domain expertise. It might be someone who knows the market. It might be somebody who knows the financiers. It might be someone that has some technical knowledge. Oftentimes, it's someone that can close your first few sales, right? Because that's so important that you get traction. Well, those people are advisors, right? They're not directors. They don't have authority to bind the company. They are there to provide their knowledge and expertise on their one little narrow area that they know about. You know, we're going to find you an investor. We're going to find you a customer. You know, we're going to get you into this market. We're going to give you some advice as to how this works. So how do we compensate advisors in a startup company? Never cash. You don't have that much cash to spend. It's always equity, usually stock options. Everyone knows what an option is, right? That's a right to acquire stock. Doesn't vote, just means you have the right to buy the stock at today's fair market value. Now, the first question that's going to come up is, well, okay, you've convinced me, how much stock do I give that guy? So there is a market for that. There is a range, and there's even a formula. And I like to use the FAST model. Dale Rossi, right down the street here in Palo Alto, came up with this. It's, I can't remember what FAST stands for anymore, but the idea is that it's a grid. And on that grid, you find the stage of the company, and you find on that grid what level of participation your advisor is going to have, now how active he's going to be, and you know what his area of expertise is, and you can find a percentage. And you just go, you know, you just go through the chart and you find this percentage, and you all initial it and agree to it. It's usually between 0.25% and 1%. Once in a while, I'll see somebody go above 1. Oftentimes, I'll see people go below 1/4. 0.25% is usually where we start with an advisor. One mistake, and again, advisors should vest, you know, just like everybody, because they might turn out to be turkeys too. So, you know, we need them to vest. How long do you think an advisor should vest? Anybody?
We always say that.
5. We got 5. 3. Okay, I got 2 in the back. Okay. Sold for 2. Advisors usually vest over 2 years. I say usually. And the reason why is because, remember, these are people, they're not consultants, they're not employees, they're people that are there for their one little specific thing that they do. I'm an advisor to a bunch of companies on financing strategy, but my part's going to be over within 2 years, or, or we haven't done our job, right? So the vesting will last about 2 years. The other thing about an advisor is, like I say, we're not consultants, we're not employees, we don't show up at work every day. So how do you know we're doing our job, right? Advisor agreement should have milestones and deliverables. I'm wondering if I got a pointer on this clicker, and I'm afraid to push a button and try, because the last time I did, I crashed everything. So I guess I'll assume I don't. Milestones and deliverables. So if your advisor is there to get you 3 big customers in the first year, well, they're going to vest as they get those customers. That's a milestone. That's what we mean by that. And that when they don't vest at all, if it turns out they can't deliver at all. And it may be through no fault of anybody's, they just can't sell your company. And again, stock versus options. For an advisor, I like options. I'll sometimes do stock. And it kind of depends on whether the company has an option plan or not. Well, let's talk about that. So what is the difference between stock and options? So this is real. I was thinking about this today because I was going over my firm's standard stock option plan, trying to update it. But 20 years ago, we did so many option plans. Every company had an option plan. We just cranked those things out like you wouldn't believe. Just every day, just option plan. Everybody did option plans. And, I don't see nearly as many these days. Now, there's a couple reasons for that. Mostly it's a regulatory reason. Because Silicon Valley here, they say it was built on sweat equity or equity compensation. And we had, up until about 2005, we had this really sweet deal going on here in Silicon Valley where people could put no money into a company and they would get these options that were at a penny, meaning they have to pay a penny to exercise the option and buy stock that might be worth $100 a share, when they exercise. And the stock value would go up and their wealth would just ride up and they didn't put anything into it. And the SEC just hated it. The SEC has always hated that. They called that a cheap stock issue. They said it was overstating the company's earnings because there weren't charges being properly taken. And we had those battles from time to time, but it only really became a problem if your company went public. And not many of my clients go public. They tend to get acquired. So no one would ever know. Well, in 2005, the IRS got into the act and said, you know what? We hate it too. So they imposed a tax on cheap stock. And they made it really expensive for people to adopt option plans. I say really expensive. I mean, it's a few $1,000s. You have to get a valuation. Just expensive enough that my startup company clients don't want to do it. They don't have to. They don't want to have to hire a professional valuation consultant. So that's why we started doing restricted stock instead. So instead of having an option plan where we would grant an option, now early companies will just grant stock and put these vesting restrictions around it. We see that a lot more now to avoid what they call 409A. That's the code section. Or we do something called phantom plan units, where we give people a bonus plan, a contractual right to receive a payment that is equal to what they would have gotten if they'd had an option. Something like that. So we see very creative alternatives out there to options. But at some point, if your company is successful, you are going to have an option plan. You're not going to be giving stock to every employee. You don't want that many stockholders on your cap table. Instead, what you want, because stockholders vote and stockholders sue, so you don't want them. What you want is optionees. So eventually you have an option plan, and at that point you will get a professional valuation. So usually what I do with companies, because everybody kind of struggles with this, it's like, well, I don't want to pay $5,000 for a valuation, but I need to give this guy something to be my advisor. Should I give him stock? Should I give him options? So here are your choices, just so you know. One, you can just grant them restricted stock. It's easy to do. Don't try this at home. You still need a lawyer because there are securities law requirements. Or two, you can give them a promise to give them an option when you do get around to getting an option plan. And as kind of ephemeral as that sounds, it actually works. You know, that's how we oftentimes do it. The offer letter will say, we will recommend to the board of directors that you get an option grant of X dollars as soon as we put an option plan in place, and we're going to do that as soon as we get funded. And it kind of means the same thing, because if the company doesn't get funded, it's not going to have an option plan, and none of this is going to matter anyway. I think we went through vesting. I want to move this along a little bit. You know, I'm going to pause on this one for just a second, because in my book, I talk about like big mistakes companies have made, and this is a big one here. This messing up with misclassifying employees. And you don't hear about it a lot until a company becomes successful. And I talk in the book, I wrote the book before HomeJoy went under, but that's a big gig economy business. They had a platform for home cleaners, cleaning services, and they were taken down in a class action lawsuit, raised $10 million of venture capital, and then because they classified their people as contractors instead of employees, the company went bankrupt over that. This is a big issue for startups because everybody wants to avoid the hassle of putting people on W-2 payroll, so they make everybody contractors. And that's just one of those things you just can't do. You can get away with a lot of stuff in the startup land. You know, no startup gets wage and hour right, you know, but the investors just know that. But classification we really can't get wrong. The second thing we can't get wrong is intellectual property issues. Got to make sure that the company owns its IP. And that's all not the employees individually or the consultants. So I do want to pause on that. Like I say, in my book, I tell a lot of stories about companies that got it wrong and how, you know, what a disaster it was at the wrong time. I'm actually writing a new book. I don't have a title yet, but it's about companies that did everything right. These are stories you would not have heard about, you know, because they didn't make it into the newspapers. They just did everything right. They got financed, they exited, and everybody got rich and got happy. And the companies, and I've actually been writing about this section of the book, and I'm thinking through the companies that you didn't hear about that did the employee stuff right. You know, they never would have made it without that. So this is an important factor. So, you know, make sure you pay attention to it. I want to talk about financing because we're running out of time. Early stage investment sources, founders, friends and family, angel investors, private equity funds. Just briefly, you know, these are the traditional ways to finance companies. Used to be just convertible debt. That's where the investor loans money to the company, but that loan will automatically convert into equity when the company does an equity round, when they sell stock, what we call a priced round. The reason that investors do that is so that they don't have to value the company at that time. They just wait and they piggyback on the valuation that the institutional investor gets. The company enters into it for the exact same reason. They don't want to mess up on valuation either. That has now I hardly ever see a convertible debt anymore. Hardly ever. Now what we have is a SAFE. It's a simple agreement for future equity, or the KISS, or various derivatives of that. And that's the idea that it's like convertible debt with no repayment obligation. So it's like convertible equity. So the investor gives the company money, but the investor is not going to get that money back. They're going to get stock back at some future date whenever the company does a preferred stock round. And if it never does a preferred stock round, the investor loses their money, which is what happened with convertible debt anyway, with just a lot less paperwork and a lot less hassle. And there were problems. There's regulatory problems around convertible debt that people didn't pay enough attention to. And then thirdly, the priced round, and that is just stock. That's when the company's far enough along, they've got enough traction, we got enough metrics that we can just value the company and issue preferred stock. A couple things I want to mention here. I want to talk about the cap table before we get into what a SAFE means, because this is important, and it's important that you think about this the right way going forward. So on your cap table, that's your capitalization table, you're going to have these SAFEs, these convertibles, you're going to have preferred stock, you're going to have your options and your common stock. And this is a good exercise to start right from the beginning. How much stock are we going to issue to us founders, right? And how much should we reserve for our option pool? Not how we're going to split it amongst us, but how much should there be? So this is sort of a thought experiment or exercise that I've been going through for the last 25 years or so with startups. And I say, look, here's what we should do. Let's get out the whiteboard before we even start. We're going to do some what ifs. Because you're wondering how much stock you should issue today. You need to think about where you're going to be down the road. And my rule of thumb is you guys, the founders, you should plan on losing control after your Series B round. Not after your A round, but after your B round. You're going to lose control, meaning you're going to have less than 50%. Now, what does that mean? There's this concept of fully diluted shares. And fully diluted shares, it means not only the shares that are issued, like in my example, to all these investors. We got the founders have 5 million, the Series A of 3, the Series B of 3. But also the shares that are reserved and available to be issued under our stock option plan. That's our stock pool. And these are shares that are not, some of them are issued, some are not. Most are just granted subject to option, but that's the pool. Now this is a simplified way of calculating fully diluted. The VCs will do it differently when you get to term sheet stage. Fully diluted means a little different number for them. But for our purposes, to start back at the envelope to know where we want to start so we can get where we want to be, I'm going to say fully diluted is everything reserved under our stock option pool. Now, ideally, this is how our company would unfold. At the end of Series B, we'd have 45% of the issued stock, 38% on a fully diluted basis, us founders. The stock pool would have 15%. It'll likely be closer to 20, but close enough. Series A, I'll have 23. Series B of 23, that adds up to 100. So to get there, I'm going to back into that. That means in our Series A round, we're going to give up 3 million shares. Looks like my numbers got messed up. We're going to give up 3 million shares so that the founders have 50, the stock pool has 20, the Series A has 30, that adds up to 100. That's on a fully diluted basis. But you'll notice we have a majority of the shares after Series A. That's where I want it to be. And that means my stock pool is going to be 2 million shares in order to back into those numbers, which means I'm going to issue 5 million shares to the founders to start out. So it's that sort of exercise. And typically I'll reserve, these are rough numbers. Usually I'll start off with 10 million authorized and 8 million issued to the founders, 2 million reserved under the stock pool. But I do want to go through a little experiment like that so people understand where we're going. We're going to take questions at the end. Now, it's important to understand, you're going to hear these terms, pre versus post money. That is super important. Don't let anybody, it's especially important now because remember that SAFE instrument that I mentioned a little while ago? Where is it? Yeah, the SAFE, it's, that convertible equity. Well, does that money convert on a pre-money basis or a post-money basis? And unfortunately, everybody's been stealing their SAFE form off the Y Combinator website. Y Combinator recently changed the form. So now people are getting something they didn't think they were getting, and they changed it in a way that I think is it doesn't make a lot of sense in my mind. So it's a very simple formula. Your post-money value is your pre-money plus the investment amount. And the amount that the investor owns is going to be the investment over the post-money value. So let's use an example here. If we have a pre-money valuation of 3 million, a post-money of 4 on a $1 million raise, if we have a $1 million raise, we'll have a post-money of 4, the investor will have 25%. Yeah, sounds simple, doesn't it? But you really have to do this calculation because if you get these confused, if your investor is talking about post-money value and you're talking about pre-money value, you're going to be very surprised when you see how the actual numbers work out. So I wonder if I got another, okay, I do have an example of a SAFE converting at a pre-money valuation. By the way, these slides will be available, so if anybody wants those, just email me, and I'm happy to make these slides available, but because this example might take a little while to go through, but let me just hit the high points. Here's a SAFE converting at the pre-money valuation. So we have 1 million shares of common. We do a convertible note of $1 million. It has a discount. That means the safe or the note is going to convert at a discount to the preferred because they got in early. So they get 1.25 million shares or dollars worth of stock in exchange for their $1 million. And the company does a Series A at a pre-money value of $4 million. Okay. So here's what our cap table looks like. Series A gets 20%, right? Because pre-money is $4 million. That means our post-money is $5 million. $1 million over $5 million is 20%. And the common and the safes take all of the dilution in this case. Our Series A got the full 20%. And our common shares and our safes, you know, they took all of the dilution in that. If we had converted post-money, in other words, if the company did a Series A at a pre-money of $4 million and a post to 5, you'll see that the Series A gets 20%, gets 16%, and the common and the safe doesn't, see the safe is converting the safe is at a pre-money valuation, but the common and the Series A are converting at a post-money value. I'm sorry, I said that exactly the wrong way. The safe is converting post-money, the common and Series A are converting pre-money. So the terms that are in the safe are like really important. It kind of defines what they're going to get in that financing. And as a practical matter, what will happen is the Series A investors, they'll adjust their numbers so they come up with 20%. They're not going to take 16%. But the safe, the document says what they're converting at a post-money valuation. So that means the common's going to take all the dilution. So pay attention to those terms in the safe and make sure you kind of do a bunch of what ifs. I really want to jump ahead here past the VC stuff because there's some more things going on. Starting in 2012, we talked a lot about crowdfunding and how companies were using crowdfunding as a creative way to raise money. And we've had a lot of experience with that. You can read lots of statistics in our slides. And we learned a lot about crowdfunding. And out of crowdfunding came crowdfinancing, which is the idea that the company can sell stock out in the open market or on a crowdfunding portal and raise money from the crowd rather than from some individuals. I will say that there are a handful of sites that are doing this really well now. And I just read in the advance sheets last week that there's one fairly well-known site that FINRA just suspended. That's the SEC Enforcement Division had just suspended from doing business because they had so many fraudulent companies on their crowdfunding site. You have to be super careful if you're going to do a So crowdfunding, that's where you're not selling equity. That's Kickstarter, Indiegogo, right? That's rewards-based, people are just giving you money. Maybe they're getting a product. Crowd financing is the Jobs Act. That's where you're selling equity on a portal. The two things I'd like you to take away from that here is like, be super careful where you list. You do not want to be listed. You don't want to be in a market for lemons. You don't want to be in a portal that has a bunch of frauds, and they are out there. Well marketed, heavily funded, promoted, slick-looking portals with nothing but fraudulent companies on there. You're known by the company that you keep. So don't be on that portal. Be on the ones that have had really, big successes and are well known. Number two, if you don't have to do a crowd financing, then don't, because it is a hassle. It's very expensive as a percentage of funds raised. And it, so far it has not affected the companies I've had that have done it, hasn't affected their ability to go on and do later institutional financings. I thought it would, but it hasn't. So I don't know if that's that big an issue, but there are easier ways. The other thing the Jobs Act did is it made it easy to go online like an angel list type site or basically an online internet venture capital firm and raise money from accredited investors. So larger amounts, more sophisticated, wealthier investors. And that's a very legitimate way to raise money. So keep those in mind. Now, if, of course, the alternative now that we've all been hearing about my last 4 minutes is tokenization, tokenized offerings, ICOs, STOs, IEOs. And Rob and I have done several seminars here that go for a whole hour on this, and we'll probably do some again. Just We've had 2 or 3 years now of experience with the ICO, that's the initial coin offering, and that is the idea of selling this digital asset. Code is law. It's just a digital asset that we're selling like a security. And for a long time, there was a lot of agonizing over whether the token, like the cryptocurrency, was a security or not. Where we are now, I think, is where we've all pretty much conceded that most of these deals are going to be securities. So we're going to treat them like securities, and now we have the thing called a security coin offering or security token offering, the STO, which can be tokenized stock, or it can be a token, digital token tied to a specific asset. And that's pretty much over. I mean, by the time the ink dries on my slides, we're on to something new. But those are still out there. I mean, we're still doing them. But what we have now, if I have any, I don't have any, is the initial exchange offering, which is a lot like selling a token, but selling it directly over an exchange. This is a heavily regulated area. There's a lot of uncertainty. It's complex. I just want to mention it because it's something that companies ought to think about. And we'll do additional presentations here if you're interested in this topic, where we'll do a deeper dive into what it means, how it works, whether it's right for your company. All right, with my last 2 minutes, you should be thinking about the exit for your company the day you form your company. All right, everything should be, targeted towards that exit. Your intellectual property strategy, should be targeted towards that exit. Steve in the back he's our patent lawyer. He's thumbs up on that because your acquirer, they might want to have, patents that are designed, to fit their general business. Your articles or your certificate of incorporation should be targeted towards that exit. You should be thinking about what you're going to do with your stakeholders when you do have that sale. You might be thinking about earnouts and contingencies. So, again, maybe the next one we'll do, Rob, will be on exits. But the takeaway here is that this is not something to just worry about down the road. Decisions you make today and how you set your company up are going to have a huge effect in determining how much money you get for it when you sell it down the road. All right. I don't have time to go through these. So I guess the last thing I'll say about exits is that, we're in good times right now, but everybody's waiting for the next recession, so we all know it's going to happen and be prepared for it. And when it does, we see a lot of acquisitions. We see a lot of M&A activity. So I expect to see a lot more M&A activity in the coming. In fact, it's already started. In our office this summer, we're much busier with people exiting. I think they're worried about getting out now at the top of the market. But if you're not at the top of the market, what you're going to see is the acqui-hires, right? You're going to see companies acquiring other companies, not because they have value built up in their technology or their products, but they really need the people, and now's a good time to pick them up. That's the acqui-hire. The reason I mention it here is because there are right ways and there are wrong ways to do that. But I think, Rob, we're going to have to save that for another presentation.
So the splitting of the pie, we're talking about in the beginning before doing a safe or anything, having some kind of agreement in place. This has to do outside of whatever pool you have, anything else, some agreement that you have in place so that you can have agreement between each other, regardless of whether you've raised any money or not yet. Mm-hmm. Just making sure.
Yeah, that's all we're talking about is how we're going to divide the equity among the founders, right from the beginning. Because you only get one shot at that, and then you have to agree to it. And the methods that I gave you were just different methods that you would divide up equity among founders.
And how many pages usually an agreement like that? Just a curiosity, is a complication of that legal document.
It's not a complicated agreement. It's
couple of pages?
Well, it's more than that, but it's a 5 or 8 page agreement. But the tricky part is not that's the easy part. Drafting the agreement's the easy part. The difficult part is implementing and make sure people have the discipline, to follow the agreement. And if they don't, then well, that's something you might want to know early on anyway.
Have any of these documents been standardized, like safes or anything else, simple ones, considering how often it's done?
Yes and no. You can go online like anything else And I know your Google search is as good as my law degree, so feel free to go online and pull down a document. You'll find them on the internet. But my view is they all really have to be customized because every company is different. You know.
It's good to have a basis and then go.
Yeah, you should. It's good to take a look at them because once you read the agreements, you know the concept's pretty simple. Once you read the agreement, then you know what you're dealing with. And then the devil will be in the details because I think every company's, because some companies you might want to value IP differently, you know, than other companies. Or you might want to value, you know, you might want to weight the factors differently. You might want to have different factors.
And all the ones you mentioned at the beginning, basically, all the different ways.
Yeah, I think so. I mean, let's imagine a scenario where your company, somebody is bringing a really big customer with them. They have a big relationship. Well, that ought to be worth something. So, you know, it's a customization that you would make to this formula.
Do you ever increase the authorized stock pool before Series A, or I'm sorry, during Series A?
Yeah, all the time. All the time. Well, right before. Okay, so let me pause on that. So, and this is where you got to pay attention to the cap table because you'll totally get screwed if you don't understand this. When you say Series A, let's assume it's a big bad VC. And they're going to say, look, part of our deal is we want, you know, a 20% stock option pool. But we want you to increase that pool before close. So why do they say that? Why do you think they want you to have the increase to the stock pool before they put their money in?
They want 20% discount on the valuation.
Something a little more specific than that. That's right. Yeah, you take the dilution. You take the dilution. If you increase the pool after they invest, then they dilute with you. So, you know, but everybody knows that now, and it's always written that way in the term sheets, and we just live with it. That's just part of the game, you know, give them their little win, okay?
So basically the 10 million that you authorize at incorporation, that should include Series A that you would give to VCs, or would you increase
No,
that 10?
no.
You would increase that 10 million?
Yes.
Okay.
Yeah. You want to know why?
Yeah.
Okay. Not to bore you to death, but the state of Delaware is where most of these companies are incorporated. And if your plan is to go to venture capital, they're going to insist that you be incorporated in Delaware for reasons of Delaware corporate law. The law there is more flexible, it's more friendly, it allows you to do kind of common sense things, whereas California, of course, does not. So they'll make you move to Delaware. But in exchange, Delaware has got their own Nigerian scam going on, where they charge a fee based on what they call the par value method, based on your capital. But if you work through the calculation, the amount of that fee payable to Delaware will increase the larger the spread between your issued shares and authorized shares. So that's why I would always authorize 10 million, issue 8 million. I've only got a spread of about 2 million. We can live with that. I wouldn't authorize 50 million because at the end of 3 rounds of financing, that's where I'll be, because that would make my Delaware tax go really high. So that's the big reason. That's one reason. That's my reason. There are other more theoretical reasons, less practical, less dollars and cents today. The other reason is, you know, you want the company to have to go back to the shareholders to issue a lot of shares, and that's a way of forcing them to do it.
I have a question around Section 83B. What's the right timeline to sort of file Section 83B? Is it right after the incorporation, or once you have your
Let me go back to
option
that.
pool planned, or right before the investment is coming in?
I skipped over it, so I'm going to go back to it. But because everyone knows what an 83B election is. So in tax law, remember what I said. Whenever if you're an employee of a company, and as a founder, you are an employee of that company, or a service provider at least. If you buy property from your employer and pay them less than what it's worth, well, the difference is compensation, right? So like if my employer sells me a Ferrari for $10, well, I got to pay tax on the difference in value. That was his way of compensating me. Same with stock. You buy stock from your employer for less than what it's worth, you have to pay tax on the spread. The other rule to keep in mind is that if property is unvested, if it's subject to a substantial risk of forfeiture, in other words, if you might lose it, the tax law does not treat that as belonging to you until it vests. So, typical company, it's worth very little. I put $100 in, I get $100 worth of stock back, right? So there's no compensation element in it. But the stock doesn't vest until 5 years from now. Well, at that point, that $100 worth of stock is worth $100 million. Remember what I said, the tax law treats it as becoming mine at that point, when it's worth this, not when it's worth 100, meaning I've got $100 million of compensation income. Well, that's a bad result. So Section 83 of the Internal Revenue Code allows you to make this election and say, look, we're going to ignore this vesting restriction and treat the stock as being mine on day one when it's worth 100. So I paid 100, it's worth 100, it's all mine, there's no risk of forfeiture that we need to worry about, therefore there's no tax. That's an 83B election. You file that within 30 days of transferring the property, 30 days of the stock issuance, meaning 30 days of the date that you sign that agreement and write your check for $100. That is a hard and fast date. If you file it on the 31st date, it is completely ineffective. 31st day. It's got to be within those 30.
But can you sort of extend the issuing of those options until you raise the money?
It's not options, it's stock.
Stock. Yes. Sorry. Yeah.
No, you want your stock. Well, you could, but then you've got a company that has no shareholders. And what happens if you get to the investor's going to want to know who the founders are, who the stockholders are. Yeah, you could certainly do that. And companies, I've seen companies do that. It's kind of risky because I've also seen companies do that where one founder realizes they got tremendous leverage now because they have to sign something, and they get a little more than they should have. As a lawyer, I like to get things in writing up front.
Thank you.
Right behind you.
The 83B is only valid risk of forfeiture, right?
I'm sorry?
It's only valid if it's only relevant if there's a risk of forfeiture.
Yeah, so substantial risk of forfeiture. And what that means for our purposes is that if you can lose the stock because of termination of employment, that's a substantial risk of forfeiture.
Okay, thank you.
Can you hand the mic to the woman over here? Thanks.
I guess I'm just curious about the milestones and deadlines for advisors and such. Does that get renegotiated often? And it seems like it could be very misjudging the market, or I wonder if I'm just curious if that happens a lot where where those are missed and then.
It shouldn't be contentious at all. It should not be contentious at all. And the reason why, because let's take a typical advisor. Suppose you hire an advisor and the advisor, I do a lot of work with agriculture technology companies, so I'm going to use an example out of that. So I get a lot of techies here from Silicon Valley who, they don't know a horse from a cow, but they're doing an agricultural app, right? And by the way, that's true. I swear to God, I was driving through Fresno with somebody once, said, see, why do those horses look so funny? It's because they're cows, they're not horses. So, but they know technology, right? Well, they need to find people that are going to get them that first big farm, or not even big, but their first farm customer. They need someone that speaks that language, that knows those people. So the milestone ought to be, look, when you get our first customer for us, then you vest in 10% of your stock. When you get the second one, you vest in another 10%. Otherwise, they don't report to work, they don't punch a time card. How do you know that they're doing their job? So I think milestone vesting is pretty important for for these people.
Maybe just, sorry.
I want to give everybody a chance.
A little bit back to that 83B question and postponing the issuance of stock to founders. Isn't it true that if you postpone the issuance of stock to founders, splitting the pie until the moment when you are very close to the investment round, to the priced round, it's kind of the same as postponing the incorporation to that point, and if you issue stock then, cannot actually issue it for pennies and the next day sell to investors in Series A for $1, $2 per share.
Yeah, that's the problem. So that's right. That's exactly the problem with the formula. So the way that I've approached this is to issue all the shares up front. So no new shares are going to get issued. We're not going to issue any new shares. We're just going to use the formula to determine how many of those shares you get to keep. So you might have to surrender some. Now that sounds like a triumph of form over substance, but Section 83 is a triumph of form over substance as far as I'm concerned. I mean, and there's no rulings on this. The IRS hasn't ruled, so it's not guaranteed. You know, where's my disclaimer at? Hold on. Remember what I said right at the beginning? There it is. But yeah, that's exactly the issue, which you just said. And that's the one problem with that.
The second question is, how often do you see the investor when they come in to push the founders to reallocate the stock because they kind of
All
see
of
that it's
all
not,
of Well, to reallocate stock or vesting?
not reallocate the shares between the founders because they think like this founder is not deserving that much of stock
Yeah.
and is under risk of quitting.
Almost always vesting. Almost always will say we need a new vesting schedule for you guys. And in fact, let me pause on that for a second. So that's why, you might think about preemptive vesting. You might say, well, yeah, there's only 3 of us and we all agree we're going to be like super favorable. But that's the pigs get fat, hogs get slaughtered theory. If you're too super favorable, then you've picked another fight with your investor. So you might do something that's more market, so that it's market, but it's favorable market to the founder, so that the investor says, close enough, and they move on to the next thing. Because oftentimes they're going to want to, redo the vesting and reset the schedule. Now, as far as reallocating the shares, that does happen sometimes, but that is a much harder sell. That's a much tougher sell, because it's really hard. That's why I think it's important to get it right up front. It's pretty hard to take shares away from somebody. And I know you can blame the investor and say, look, we're not going to get this money unless you give up these shares. I've been on both sides of that conversation many times. I know how it goes. But I still think it's a hard sell, creates hard feelings. But it does happen. I think you had another question.
Yeah. Actually, you can go ahead. You can go ahead.
I'm just curious, how many lawyers do you recommend for a founding team?
How many lawyers? How many lawyers does it take to start a company?
Well, in part because Ryan Howard in healthcare, for the founder and CEO of Practice Fusion, goes out touting to protect yourself because you can get ousted. So he has 2 lawyers, one for the company, one for himself. And so if each founder has to protect themselves, then each founder may need to have their own lawyer.
That's a great lawyerly answer. One lawyer for everybody. I like that. It's a full employment act. Well, 2 things about that. Yes, in a world with no risk, everybody would have a lawyer. And I mean, you saw that movie Social Network, where the Facebook guy, he's sitting in a deposition and he said, well, why did you sign these documents without a lawyer representing you? He said, I thought I had a lawyer. I thought the company's lawyer was my lawyer. So I've seen that happen a lot, by the way, where the founder didn't understand that they weren't being represented. They just assumed that a company counsel was taking care of their interests. And I got to tell you, they are absolutely not. They are ethically prohibited from doing so. They can only, as company counsel, I can only look after the best interest of the company, not any individual participant or constituent. That's just law. So, but as a practical matter, we sort of assume that we're going to stay close to market, and a good company counsel is going to tell you when you vary from market. So, for example, if the investor comes in and says, hey, look, all the founders, we want them to have 10-year vesting, presumably company counsel would tell, the founders that that's a little out of market. That's probably not in the best interest of this company. Now, having said that, I have seen founders get totally just, I'll tell you one more story on this. This woman came to me, that was about 5 years ago. She read in the newspaper that the company she had founded was being sold for $500 million, was exiting for $500 million. There were 3 founders. She was one of them. $500 million that company was selling for. You know how much she was getting out of that deal? 0. So we had to investigate. So we contacted the company, and it's a long, complex story what the venture capitalists did to the company, but basically through a series of down rounds and something called full ratchet anti-dilution, you know, and pay to play and all these different things over a long period of time, they had basically washed out the founders, the seed money, which was her friends and family, the Series A, the Series B. You had to have been a later investor to get anything in this company. $500 million, and she got nothing. And I went back to company counsel, and I said, how could you let this happen to these founders? And they said, well, that's just the deal we negotiated. And I said, yeah, but I said, do you think they understood when you put this full ratchet anti-dilution and this down round and this insider, do you think she understood that she was getting completely wiped out? And he says, what do I care? She's not my client. Company's my client. So yeah, once you get at a certain level with a company, everybody ought to lawyer up. You know, everybody ought to have their own lawyer, but it's a practical matter, an early stage startup. It's just not practical. There's just not enough money to go around. I mean, yeah, my clients can't even pay one lawyer, much less one for every founder.
How is it possible to get past the A and B round, attorneys?
What's that?
In that case, how was it possible to get past the A and B round, investors, attorneys? I can understand having founders, but I'm surprised the A and B round people that happened to them.
They were sophisticated and they knew what was going on, and they weren't surprised, I assume, you know, or they didn't have any choice. Probably didn't have any choice. I don't recall, but remember how I said people like to go to Delaware? This is why. California, every class gets a vote, so the A could have blocked that every one of those financings. But in Delaware, you vote, all shares vote as a class. So as long as you got a majority of all the shares, you can ram these provisions through. That's why the VCs like Delaware. I'm not trying to be anti-VC here, you know. Don't get that impression. Some of my best friends are VCs, you know, but I'm just saying that this is business, so you have to be aware and wise. And you raise a good point back there. So here's a good rule of thumb for you. If somebody's asking you to sign an employment agreement as opposed to an offer letter, something that's more than at will, then I think you need your own lawyer. You know, at that point, because you're giving up real rights at that point. If you're you know, beyond your first round of financing, and if you're being asked to do anything differently than anybody else, then I think you need your own lawyer. If you're in an exit, you certainly, you know, should be advised to get your own lawyer. In other words, the company's being sold and you have to go with the buyer, you know, to be employed by the buyer and be a transitional, then I think you need your own lawyer. But in this valley, founders don't get their own lawyers until they're way down the road. How often do they change lawyers after incorporation? Yeah, you know, how often do companies change lawyers after incorporation? Pretty frequently, because, so if you think about it, you know, a startup is a really multidisciplinary thing, right? It requires a lot of different disciplines, and you hear people like me say, I'm a startup lawyer, but there's really kind of no such thing because there's so many different things that a startup needs. So I think you said you're in healthcare in the back. Well, you know, your startup lawyer probably is not an FDA expert, you know, so you need someone who does that. You know, there's going to be tax issues, and they may not be a tax expert. I always call in IP people. You know, whenever I have IP people look at it if it's complicated at all. I wouldn't touch a patent with a 10-foot pole. So it really requires a lot of different lawyers. But these days, startups change lawyers a lot because everybody's incorporating online with LegalZoom and Clerky and some of the online services. And I'm all for it, by the way. I'm all for those online incorporation tools because it's a good filter. You know, it's a good filter. Well, I'll just leave it at that. Okay. Go ahead.
How common is it to have non-linear vesting schedules?
Non-linear vesting schedules.
Yeah, so where vesting weighs more heavily towards tenure.
Oh, I don't think I've ever seen that. Yeah, not common would be my answer. At least not in my experience. And by the way, you want to keep your documents simple. I mean, I think it's a good idea to try to keep it simple. I mean, I've seen people do things like that where they, and so what I was saying about milestones, that's the one time you'll go outside the four corners of the document investing with an advisor agreement. That's the only time I really want to do that. A lot of times people say to me, well, we want to vest based on whether the company raises this much money or whether it has this much revenue or whether it hits EBITDA. That's going to drive your cap table people crazy because you can't figure out from the documents who's vested. So resist that temptation to have complex performance-based vesting provisions. I have companies that do it, and it's a nightmare. You know, she hasn't had a chance yet, so why don't you take the mic?
About half an hour ago, you mentioned that we're expecting a recession
Yeah.
and also a lot of M&A activities in your firm lately. And my question is that also you mentioned that when we start the company, at the time we should think about exit strategies.
Yeah,
Then there are two big ones. One is being acquired.
yeah,
The other one is going IPO.
yeah,
Maybe the third one is just self-sustainable, making
Right.
money, making income.
right.
So my question is that during recession, have you seen from your past experience, or do you anticipate that there will be what will be the exit strategies more common during recessions?
Yeah, I have a whole. In fact, I've just come up with the content for the next one of these we're going to do. We're going to do one on exits because I think what you're going to see going forward, probably a lot more asset deals because companies, well, there's tax reasons for that because the tax law has changed. And what I mean by asset deals is buyers just cherry picking the assets they want. Like I said in the slide, I think we're going to see acqui-hires where you're not going to see much value allocated to the assets at all, but you're going to see a lot, big fat employment agreements. Yeah, there it is. I think we're going to see what we call troubled company terms, where investors have to convert in fact, I'm seeing it already. I'm the canary in the coal mine, by the way. I'm seeing companies now that were just darlings, 6 months ago, now going back to the investors saying, you gotta forgive that debt, you gotta convert it to equity, we're not doing as well. So I'm already seeing the early signs of it. So we'll see all of that stuff. But the acqui-hire is the big one. And I also call those the no net value deals. It's where you buy a company, but there's no value. You're just picking up the people. Remind me to tell you about the Marvell case sometime. That was an acqui-hire that I talk about in my book, which you can have if you go on Amazon and buy one. Is you have a follow-up? Does that answer your question?
Sort of, yeah. And anyone have any follow-up questions? Yeah, sort of, but not exactly.
Well, in terms of structuring your company, I think what it means is you said something really interesting about how maybe your company is not going to go IPO. Maybe it's not going to be $1 billion exit. Maybe you're going to be a good, what I call a lifestyle business, right? Maybe it's just going to be able to provide enough income for you, the founding team, to live on comfortably, or maybe it takes off, maybe not. Yeah, so that's a choice of entity question. Because if that's your company, and we do a whole presentation here on choice of entity, then you're not a typical Silicon Valley startup. You shouldn't be a C corporation. You shouldn't have safes. You shouldn't do any of that stuff. It's all going to be taken apart on the back end. You should be a limited liability company and just enjoy the tax benefits that current law provides you as a lifestyle business. And by the way, it does. No better time to be a small business probably ever in the history of this country than right now. Because of the tax benefits. You get a low rate of tax. That's the biggest thing. Very low rate of tax on these sorts of businesses.
Because under the law uncertainties, sometimes you may have to change business model.
Yeah, and that's why I like LLCs, because it's very flexible. So
Can you change it back?
you can change it back. You can go from LLC to corporation. It's very difficult to go from corporation to LLC. So you raise a good point. I mean, I talk a lot about this, usually to lawyers. And let's suppose we're here in Silicon Valley and we got a company and I say, well, gee, if you're going to be in explosive growth, where's Gary Jenks? He always says that. Explosive growth, Silicon Valley startup, then be a C corporation. Does everyone know what a C corporation is? Right? It's a corporation, it's taxed as a separate entity. If you're going to be a lifestyle business, be tax efficient. You see, VCs won't invest in LLCs. They will only invest in C corps, right? So if you're not going to take VC money, then be more tax efficient. Be an LLC. Your tax bill is going to be, quite a lot less, 20 percentage points less. Well, what if you don't know, right? What if you don't know? You've got a business that's profitable, but you've got this app you're working on that could scale. But if it doesn't scale, it doesn't mean you're dead. It means you go back to your profitable business. Well, then you be an LLC. And if the app takes off, you convert it to a corporation. I've done that transaction 100 times. You convert it to a corporation and go get your financing. If the app doesn't take off, you're in the right structure with the LLC. So that's a decision you make right up front. I mean, there are more subtle decisions that I was talking about here, like how you're going to deal with earnouts and contingencies. How you're going to, how the VCs are going to be built into your articles. But that's a whole nother presentation.
I'm following this model, so I'm new here to Silicon Valley. I came last Saturday, and I'm following this model. So I established an LLC company, but it's not here in US. It's registered in Estonia. So I want to see if and it's all my business model is online, so you can buy services online, do everything online. So my question is it legal to for any business here from the US to use my online services and to continue with the services? So you know my question.
Why wouldn't it be? What are you selling?
So my services are like Messenger. I'm doing automated chatbot for Facebook Messenger. So it's automated and online, and everything is online. So I'm here like on my tourist visa. So and I'm
I get it.
but I'm not like getting money from. So they are like subscribing to my online services.
Yeah.
Yeah, and I pay tax like 20% tax in Estonia for every subscription.
Yeah, well, I typically punt on immigration issues, but as you know, you're not allowed to work here in the United States on that visa. But a lot of companies get started here by people here who do not have B or H visas, who aren't allowed to work here. They don't draw a salary from a company, they just own the company.
But technically, I'm not working here.
I know, that's what people do. They technically do not work here.
Yeah.
They just happen to own a company that does business here.
Uh-huh.
And I don't want to know any more about it. Okay, Rob, back to you.
All right, let's give it up for Roger.